So without further ado, I'm just going to let Mike take the floor and go with it. So thank you very much, Mike.
And thank you very much, Terry. She always makes us feel really at home. Okay, now I told you to turn these off when I went to the washroom. Yeah. They were off, right? They were off. Are they on now? Am I good? Yeah. Oh, that's better. That's better. Not that I need one of these normally, as most people say. So I'm Mike Bondy, and I guess I have to put on a hell of a show because she said I would. So I'll try, and with a little bit of help from my wife and her beautiful pictures and some other people, we always try to keep it a little bit interesting. So part of the reason we did changes in latitudes, changes in attitudes, was because the end game was getting kind of boring. So I thought that I better do changes in attitudes because a lot of things have changed recently under the Tax Act and different things that have a big, profound impact on all of you, and that's about to happen soon. So this is me. This is a fellow by the name of Mexican Mike who, this is down in our place in Mexico. Not one of my better days. One thing that's really interesting, I was actually speaking to a US tax expert today, and I said, what's going on in the US? And yes, he actually was working, because he didn't work for the government. He's actually working against the government, and he basically said it's crumbling, and we're now a third world country. So I thought I'd throw this in and just say, because he told me, he said, yes, the United States of third world countries now, because our government can't do anything, nobody can do anything, so it's just gone. Anyway, that's a more recent thing that's happened. Okay, now I've got to get this going. So this is Collins Barrow. We're 900 professionals, 175 partners, 24 member firms, basically all across Canada. We have an international affiliation. I was on the phone today to a fellow from the Netherlands, setting up a meeting for him November 21st. Otherwise, I would have never known who to call or who to do stuff with. So basically, they're very helpful to us across the board, and we've been with them now probably about 10 or 15 years, I think, so we're quite pleased with that. This is the disclaimer and copyright, so all you accountants can't touch any of this data or anything, okay? That's the way it is. So the agenda. So the way I'm going to start out with this is changes in the taxation of dividends for corporations and the impact of planning, marginal tax rates and how much is after-tax income, the new plan for savings and RRSPs versus corporation, pre-retirement planning, what I call the 4 pillars of assets and where to hold them, the new endgame plan, and how life insurance works into the plan. This is normally a 4-hour speech, but I will somehow get it into 2, I promise. So first of all, we're going to take off as we go. So this is into the wild blue yonder. It's not so clear what to do right now. So what's happened is that the Ministry of Finance, who really handles everything, it's not really CRA, they sort of came in and they messed with our world a little bit because there used to be a big benefit to everybody from earning dividends and everything else. So for those people that were here for the last time I gave this speech, that whole plan has changed. And basically, we're sort of revising it right now. So basically, I was able to keep like one slide, and that's this one, and that's it. Basically, the old plan was to utilize your PC, draw down on dividends first, and then take out your RIF after age 72. Collect CPP at age 60, reduce the CPP cost to make it worthwhile, collect old age security at 65, and try to minimize income to avoid clawback. This is still a viable plan depending on how much is saved in your PC. If it's under $500,000 or less, that actually might work. The slides that you have are not all the slides, so if you're looking around for them, it's a trick that I play that means you have to pay attention to me and not read ahead. So that's the way that I've done it. So basically, this has changed now, and they've just done this change where they've bumped up the tax on dividends. So it used to be that you had a 3.4% benefit of receiving a dividend compared to receiving a salary or pension income or anything else. They've knocked that back to 1.4% starting in 2014. So what that means is that old benefit that used to be there from incorporation if you couldn't split income or do anything else is really been nullified almost down to 0. And we think that eventually between Ontario and the federal government, they're going to get around and do total, that both dividends and straight income are not going to matter which one you take. And really it's very small. The decrease in the gross up of dividends is from 1.25 to 1.18, which does help after you retire. There's a super tax now, and I don't know how many people here are over 509,000, but if your income's over that level, your tax rate now is 49.5%. So one of our goals is to not have anybody be at that level. And there are ways where you can get to that level if you die with too much in RRSPs and things like that. So this super tax just came in, and that's affected some of our planning for our higher earning specialties. The testamentary trust rules, last time I gave this big long speech about how we form testamentary trusts, and then we create a separate person upon death so you can split income, your spouse and the trust, etc. Well, the accountants in the room know that this is being challenged, and the Ministry of Finance is basically looking at it. One of the beauties of being the chairman of STEP is I've talked to the guys on the Ministry of Finance. This will go through. So they are going to be reducing this benefit. They may grandfather it for trusts that are in place right now, but they're really after this ploy. So those 5 slides that I used last time on estate planning and doing everything, basically I don't think are going to be any good in the future. So that's another change that they've done that's profoundly affected our planning issues and the way that we do things. So these changes all take effect in 2014. So review if you want this year. Some people are talking about moving dividends ahead a bit. So if you're planning on taking a big dividend in early 2014, maybe better to take it in 2013. Talk to your accountants and look at the benefit of that. These changes may not seem large, but they do change how you should be compensated in the future. So the dividend-only strategy, in my mind, should be modified in favor of maximization of salary income to contribute to an RRSP. This depends as well on if you have any UWO or other pension income. Avoid the CPP penalty, though. So as many people know, if you're getting a salary from one source and your professional corporation pays you a salary too, you actually end up losing about $2,500 a year of CPP that's just thrown out the window. So we try not to get into that at all. But definitely it's a time to look at your planning again. Changes in latitude are costly. I did have to put this in because I did say changes in latitude, changes in attitude. This is Groupama, which is one of the Volvo ocean racers. You cannot afford that boat after you retire. Nobody in this room can, me included. But I was lucky enough to get on the helm of it for one day. So that worked out quite well. And some people will appreciate that, eh, Peter? For sure. So recent changes in Canada Pension, okay, here's the next part of that plan that went away. Before I told everybody, when you're 60, take early Canada Pension, you can't lose. Well, guess what? Now you can lose. So CPP early no longer works, especially if you continue working, because you're going to have to contribute towards CPP anyway. So it just doesn't work as well as it used to. So you have earned income, so you can use more of that earned income to contribute more to an RRSP. Old age security, this is really the interesting one that they just slipped in for us. You can now delay when you receive old age security. Everybody knows that's the $6,500 a year that they give to everybody that's lived in Canada for, I think it's 18 years or something like that, when you reach the age of 65. But if your income is over $70,000, they take that money back. After your income is $114,000, they take it all back. I call that a super tax, because they take a lot of money back. It actually increases your tax rate to 47.98% when you're in this sweet spot that you're going to. Now what they've done is they've allowed us to defer taking that, and they're actually going to pay us to do that. So now you can defer taking old age security till you're age 70, and they're going to give you another $200 a month to be able to do that. So for many people that were going to lose it anyway, it actually makes sense to just defer it, not claim it till you're 70, and then take that extra $200 a month if you can at that time. So if you plan on working after 65 or anticipate that your personal income will cause clawback, hold off till you're age 70. Deferral means no clawback, so your income can be higher between 65 and 70, which is when most people want to spend money, when you're healthy, as opposed to later on. So since you would not receive the old age security anyway, you may as well defer it and take it. If you've already started collecting old age security, if it's less than 6 months, you can go back and defer it. So it actually is working out quite well for planning stuff. Now, be prepared to take a nap. Does anybody have any idea what this is? Manatee. Thank you. So it's a manatee that was actually kind of napping on the top of the water. So these are the new marginal tax rates, and this is why people need to take a nap, because now I'm going to talk accounting stuff. The biggest one to look at is a taxable income over $509,000. The other one is the non-eligible dividends, which are the dividends that are paid out of your professional corporation to you. They've increased the tax rate when your income's over $135,000 from 32.56% to 34.92%. It's not a lot, but it's enough for me to plan around. And I sit there and I look at that, I say, well, if it's a $100,000 dividend, it's a couple grand. Well, that pays some accounting fees. So I have to save you that money as much as I can. That's important. Taxable income over $509,000 is 38.6%. These rates have increased steadily. These dividends that are called eligible dividends, those are ones that you get from corporations when they pay dividends to your professional corporation, and they're taxed at a lower rate, at that 29.54%. So that's part of our planning as well, is generate dividend income inside your professional corporation, because when you take that money out, it's taxed at a far lower rate, 5% less. Marginal tax rate. So this is where this clawback starts, $70,954. Net income where it ends is approximately $114,000. And just basically all the other information. So this is for people that like this kind of stuff. Not me, but somebody else. So this is the sort of net after tax. So what we're doing now with a lot of people is we're planning on taking out pension income and dividend income. And once you turn 65 or 70, I want to try to keep your income underneath that $70,000. With a professional corporation, you can split income with your spouse. So between the two of you, you can basically take out about $110,000, twice the $55,000 on the bottom, and still be under that clawback rate. And remember, that clawback rate at that income level goes to 47.98, which is one of the higher tax rates that you have. So it really makes a lot of sense to us that if I say to people, if I can control your income, which I can do with a professional corporation, I can do with your RRSP and your RIFs, it makes a lot of sense to keep your total personal income down at that $110,000. Now that's after tax, so that's the magical number that I use now, is you should be able to retire with $9,000 of income coming from your pensions and your corporation each year, unless you're me. And it takes more than that. So now you have to wake up. So this is the pelicans waking up here as opposed to going to sleep. How much do I take home? So this is the big conclusion. Using the dividends that you and your wife have, your personal income could be $110,000 or about $9,000 a month. If you use RIF funds instead of dividends, you can bring home about $92.75. If you take out $30,000 in RIF and $20,000 in dividends, your take home is about $92.75. So our big focus right now is that when people turn 65 or when they start to collect old age security, we really want to look at that and hone in on it and try to keep your income at those levels and take a mixture of it from different places. So part of it comes from the corporation, part of it comes from your pension. Now what I'm focusing on, and this is the big change in the end game, is it used to be leave that corporation or use that corporation's money as fast as you can and get rid of the corporation. Now, because of life insurance policies in corporations and other reasons, we're saying exactly the opposite, which is let's get rid of that RRSP and pension money. Let's cash that out as fast as possible. So now the deal is I'm saying to people, instead of taking dividends at the age of 65, we're going to take pension income out. Your still net income after tax is going to be $9,000 a month, but you're getting rid of that sort of Damocles that's hanging over your head. If you die, if both of you and your spouse die owning an RRSP, that's when the government gets that 49.5% tax credit, tax rate, because all your income comes in the last year of death, and you really get nailed on that. So I'm trying to keep people out of that, and we'll get into that later on in the end game plan, which is where the big difference is in this planning issue now. So how much do I need to save? I can't tell you how many people ask us all the time, right, Sam? How much do I need for retirement? How much do I need for retirement? Well, I tell people, I'm saying to generate the magical number of $9,000 per month, you need $1.2 million in RRSPs, $775,000 in your professional corporation at age 65, assuming 3%, and that you die when you're 95 years of age. So at 95, your income runs out. At that time, I doubt that most of us will care, so I don't overly get concerned over that. If you have less than that, if it's $1 million in RRSP and 625 in your professional corporation at 65, assuming 4% return, that gets you to age 90 using that $9,000 factor. So I shoot for $9,000 because I'm kind of saying after tax, in the early years, you're going to spend more than that, but later on, that's going to be more than enough income for most people anyway. So anyway, the magical number is between 1.6 million and 2 million, depending on returns and anticipated lifespan. And that's what I call like the minimum that I like to see. If you have more than that, you win. Great, no problem. If you have that amount, I think you're pretty good, and it's not really an issue. It can also be made up of different assets than this. It can also have real estate and things like that in it. What if you don't have it? Reality sets in. All of my clients come in and they're 60, they're 55, and they say, I don't have this much money. And I say, it's okay. Most of you work till you're 65 anyway. So because of that, you've got 5 more years. By the time you're 60 to 65, a lot of you are like I am. My kids are off the payroll finally, so I don't have to pay them anymore. They're gone, they're done university, everything else is okay. And you're able to save a little bit more money then. A lot more money. $50,000 to $100,000 a year for most professionals is totally possible. Some people now that are younger never see that, like they just can't believe it, but that is possible to do as you're going along. And remember, your income can be higher in the early years, because there's a graph that I didn't put up here, but some people have seen it on the MD management things, where they have this graph that goes, you spend this much, and then it goes down like this, and then you have to go into a home, and it goes back up like that, and then down. And that is truly what happens. It's really high right off the bat. You're traveling, you're having fun, you're doing stuff, and then you get to the point where it's like, that television show at night is really what I have to look forward to, and that's about it, and I'm okay with that, and I'll stay at home and it'll be fine, so you don't need all that other stuff that's there. Also, if you work part-time after age 65, that's found money for most people. And for physicians, it's great, because I sit there and I say, if you can make $30,000 a year, that's like having another $1 million invested in this environment, isn't it? Like 3%. That's all we can get. $1 million, 30 grand. So working a little bit helps to pay for those early years as well as you're going along. Not too much, just enough. Then you can go sailing. So that's our sailboat up north in the North Channel. Changes in attitudes. So the new plan is if you have over $750 in your PC, consider to defer the old age security till age 70 if you're still working, and have earned income if you need more money to live in. Start CPP at 65, not 60, which we've been telling people before. Start drawing down on your RRSP first at age 65. If you need the income, take as much as you need to live on at that time. Since there are no clawbacks, there's no old age security is being taken if you're deferring it till age 70, you can draw a little bit more income as you need it, and that's not a big problem. You don't pay that super high 47.98% tax rate. So that's kind of the new plan that's out there. Don't worry about, one thing everybody freaks out over is the minimum RIF payment. Everybody says, just take the minimum, just take the minimum. I'm saying, why? I'm going to have enough money. I've got my corporation for this now. So don't be afraid to take more than the minimum, especially between 65 and 70. You want to draw down on that RRSP and start to reduce this eventual sort of Damocles tax headache that you're going to have when you die. Well, I guess you won't have it. Yeah. So you can split your RIF and your pension income with your spouse. So your corporation, you get to take whatever amount of income and sprinkle dividends wherever you want. So that works very well. For your RIF, you're allowed to elect to split it equally between the two of you. So you can really manage your income very, very well as you're going along. Either way, because there's no clawback, you can increase your income from your corporation or your RSP. You can choose which one to take the funds from depending on where you want to go. So this is a real picture of a manatee. So is retirement an endangered species? I say no. It's not bad. As long as you've been saving and prudent over the years, and it all depends on your lifestyle expenditures. So again, you can also take your RIF, and don't be afraid of putting it into multiple RIFs. So guys like Vic don't like that, but we advisors like it because your minimum is based on the RIF that's in there at that particular time. So if you're under 70, you don't have to RIF. But if you do, you get the benefits of the pension credit and the ability to split that income. So it's okay to take your $1 million in RRSP and only RIF 500,000 at age 65, and then draw down on that one and let the other one continue to grow. So there's no limit on withdrawal. However, the minimum withdrawal is at age 65, a RIF of 500,000 is 20 grand. This is just for people that might be interested in this kind of stuff. So draw down your RIF first and leave your PC assets for future needs, or if you run out of cash personally. Checkerboard your extra income. Sometimes with people I'll say, you need extra money next year. Maybe what I'll do is I'll give you a big dividend or we'll withdraw more from your pension this year, and we'll put you up and we'll pay that old age security clawback for 1 year. But next year I'm going to drop your income so that you're not going to be at that. So I use a checkerboard effect. I'll also use that between spouses. 1 year, one spouse will be over, the next year the other spouse won't be. But I hate to give back. If you're over that clawback, you're basically giving the government 13 grand a year. Like, it's just huge, $13,000 or $14,000 a year. So you can have combined gross income of $140,000 without getting into clawback. Pre-retirement planning. So this is the important stuff. Do your homework first. So when I have people come in and they say, can I afford to retire? I say, what does it cost you to live? And they go, I don't know. I say, well, you got to figure that out first. That's called lifestyle expenditures. So you need to figure that out. Know your lifestyle expenditures initially and long term. So I've had people where they say, well, right now I've got the cottage and I've got the house in London that I want to retain. But that's really expensive. So Mike, long term, what am I going to do? Because that's more money than I have. I say, well, that's okay. I have a plan for that too. And I'll get to that in just a minute. But essentially, a lot of people do that. I say, don't worry. Take out more money at the start, because you may not need both those properties forever. You may move to one or the other as you're going along. Do your budget, spend more in the first 10 years, acknowledge that, get over it, and that'll work fine. Living costs will fall when you get less active. Then they'll rise again when you retire long-term care. So this actually is a bit out of spot. This is a new boat that we just bought. I have 3 partners, none of those people, because those are my family, divided by 3. The value is priceless. We're having more fun with this little thing than we've had anywhere else, and some sailors will appreciate that. And it didn't cost anything, so the cost of the toys are cheap sometimes when you split them. Prior to retirement, when your income is good, have a home line type of mortgage plan on your home and cottage. I've used home lines all the time. Different banks call it different things. RBC calls it a home line. What it is that as you pay down your mortgage, it opens up a line of credit for you. So when you're all done paying off your $500,000 house, you have a line of credit of $380,000. They've reduced it a little bit recently, where now the line of credit component can only be 60%. But if you go in and put in a mortgage component, a fixed mortgage component, you can borrow it. I love these. The banks never ask you for proof of income. They never ask you for anything about these. It sits there forever, and you can use it for a lot of reasons. After retirement, your income falls. So I've had some people come in and I've said, well, put a home line on. And they'll say, well, I'm retired. Well, all of a sudden the bank looks at it and they say, well, you can't borrow as much because you can't pay off as much. But if you had done it the year before you retired, they'd give it all to you and they don't care. And they never take it away. So it's kind of crazy. It's something that I use a lot of times, and it doesn't cost you anything. You may never use this, but it's available for. I use these to help kids buy houses and not pay CMHC fees. By the way, with kids, always lend them the money. Don't gift them the money. The bank will say you have to gift it, so you sign the form that says, yes, I gift it. Then you make the kid sign a promissory note 20 minutes later. The banks know we do this. They get it. They understand it completely, because you want to protect that house that they've just bought with their new spouse in case that spouse leaves. So it's important. Use it for yourselves as a reverse mortgage. Reverse mortgages are not very popular in Canada yet. They're in the US. They're very expensive. This is basically a reverse mortgage. So you have a line of credit of $380,000, say on your $700,000 cottage. You know that 5 years from now you're going to sell that cottage. Use it. Borrow the money. Interest rates are low right now. Who cares? If interest rates get higher, it's going to allow you to stay in that cottage and that property much longer and to do what you want to do when you want to do it. You will eventually sell that cottage and pay off the debt, and it doesn't matter. This is not even the American way. This is like the Canadian, like the Americans really owe money when they retire, like regular mortgages. This one I'm talking about is a great plan and makes a lot of sense. You use it to bridge your cash flow needs. So sometimes some people will say, well, I really need $20,000. If I take it out of my RIF, I'm going to pay that super tax rate of 47.98%. I said, take it out of your home line. Who cares? You'll pay interest for 3 months. It works great. You know, you'll save that much in tax on the interest. The banks just, so far, are just leaving these in place and not asking a single question about them. So I tell people, if you have a cottage, if you have a house, go in and tell your banker, I need a home line for it. I may put an addition on the cottage. I may do this to the house. I want to put this in place and put it in place. It just makes sense to do. Before retirement, consider buying or leasing your last deductible practice car to make sure that you go into retirement with a new car that you have deducted. I can't tell you how many times I've made husbands happy. I'm sitting there in the meeting, I'm saying, hey, you're 3 years out. Time for you to buy a car. He says, well, but my old car is fine. I say, how many miles on it? 160,000 kilometers. I say, so 3 years from now, you're going to have 220,000 kilometers on it. You're going to retire. Your first big expense when you retire will be a car. Write it off while you're working so you can deduct part of it so you're going into retirement with a decent car as you're going along. Nothing depletes capital faster after you're retired than a new car or spouse. Pay off your non-deductible debt, so be mortgage-free or mortgage very low upon retirement. If you own rental properties, you can owe mortgages against those, but make sure the rent covers those mortgages well and they're actually making you a little bit of money. Reduce your monthly expenses as much as possible by having all the toys paid off. Not a good idea after retirement. That actually is my wife in that picture. It's not my girlfriend, and it's my first wife and only wife. We did this thing where we bought this event at the charity, 4 tickets to the National Ballet, a night in Toronto, and the use of a Jaguar for a weekend. Do you think I was interested in the National Ballet? Actually, I am, but that's beside the point. So we got this car for the weekend, and we had a great time with it, had lots of fun. Then I came back, and they told me it's $107,000. In retirement, imagine you're retired, you're on a fixed income, you're not going to do that. How much is the wife worth? I don't even want to go there. That's right, priceless. Value priceless. It was up there before. Consider canceling your disability policies within 2 years of retirement because most only pay 2 years post-age 65. And the OMA policies, I understand, from Terry I get this information, only pay out till you're age 70. So a lot of times people have disability policies. You're just in your tail end of your practice, and I'm going like, why are we paying these premiums? It doesn't make any sense. Let's get rid of them. Some of these policies, like the RBC policy, can be switched into a long-term health care policy. So there are things. Talk to your insurance advisor as much as possible. Check life policies to make sure the premiums are reasonable and that you need the insurance. If it's a straight term policy and costly, probably should be canceled. If it's this OMA stuff that keeps increasing as you get older, get rid of it. Most people don't need it. You've already saved for retirement. It's not really a big issue as you're going along. And just on life insurance, I love Terry Zavitz. She and I get along fantastically. She's been trained well over the years, the last 30 years, and does everything right. I always tell people when they come in and they say, well, I want to go to this insurance agent or that insurance agent, and I say, I want you to go to Terry. They say, why is that? I said, because I probably have 300 clients that are with Terry. If Terry messes you up, she's not getting away with it. And she knows that. So it's good to have people that you trust, and I trust Terry beyond that point. So she's just perfect on stuff like that. Healthcare insurance and out-of-country insurance. For physicians, OPIP, you're lucky, very lucky. You get 60 days out of country. If you have no coverage, if you're a dentist and things like that, try to structure something so you can get coverage outside the country. Consider long-term care policies, but get the right policy. You have to trust your agent. The reason I keep my disability insurance is I'm very likely to want to do stuff like this. So I always do this. This is a guy that has the jet pack that they invented in Chicago when they were using it in the Keys, and looked like a lot of fun till he wiped out a few times. He doesn't wear a helmet for no reason, that's for sure. For the dentists in the room, there are dentists in the room, right? Somewhere? Okay. Your plan is a little bit different because you get to sell your practice. So that means that your DPC needs to be purified. Sorry for the physicians, this is gonna go whoosh for a minute, so I should get that nap picture again, right, for just a second. The sale of your practice means that your DPC needs to have investment assets less than 10% at the date of sale, less than 50% for 2 years prior to that. So consider multiple freezes and being offside of the ownership rules. We'll all shut our eyes to the province of Ontario for a short period of time by reorganization and exchanging common shares for preferred, then transferring preferred shares to a holding company, get your money out to your DPC before you sell to a holding company that's separate. Do this if you have significant investments built up in your DPC. The details are too complicated for this presentation, but the end result is you sell your practice and still have a holding company with some investments. Ensure you structure the practice sale as a share sale. Everybody knows this. You should all be incorporated and do it on that basis. You will have more after-tax investments personally from the sale of your practice. That's good news. That's not bad news. So that works well.
Why can't the doctors do that?
Sorry?
Why can't the doctors do that?
Because nobody will buy your practice.
No. Transfer the assets to a...
You don't need to do that because the CMPA will protect you from liability. So it's not normally an issue that I worry about, and you're allowed to build up your investments. If you're a DPC, if you want to sell your practice, you need to take your investments out of it first. You can't sell your practice as a physician. Most can't sell their practices. Some can, but very, very few nowadays. So these are the 4 pillars of retirement. These are not investments, but this is where you hold the investments. So there's the RSP and the pension. There's personal investments outside of corp or RRSP, professional corporation, and real estate. These are the bases of where your assets should be kept when you're retiring. And different buckets or pillars need different types of assets. So in your pension and RRSP, now, under the new endgame, these will often be the first ones that are drawn down on. The types of assets then should be fixed income securities, bonds, preferred shares, safer dividend-bearing stocks, those Bell Canada stocks and RBC and things like that. No or minimal U.S. investments unless they're inside of an ADR or mutual funds, because you don't want to deal with U.S. estate tax issues. Keep your investment costs down to below 1.25% and preferably 1%. In this industry now, the last time that we did this speech with the endgame, we focused 100% on getting those costs down. Because now when you can only expect a rate of return of 4%, when somebody takes 2, it really doesn't work very well. Because they can't get 6. They think they can, but they can't in most cases. Be sure to designate your spouse as a beneficiary of the policy. To contribute or not to contribute to your RSP. The plan has changed. Higher tax rate on dividends have reduced the benefit of minimizing RRSP. It also depends on your current RRSP position. So again, I put numbers to these that most people don't, because everybody says, well, it depends, and it does depend. But I like to say, if you currently have in your RRSP $750,000, think about the strategy. If you got more than 1.2 million, we suggest stopping contributions and saving in your corp. For maximizing RRSP, cut duplicate CPP costs. Don't bother. Don't pay that penalty on CPP. Then you get to go fishing. I never catch anything in this location, though. I really hate that. That's bad. So your personal non-RRSP investments, while more tax efficient to save in the corporation, everybody needs some non-RRSP. So a lot of times everybody says, save all in the corporation, save all in the corporation. Then you come to go buy that $107,000 car, and you got to take out money out of your RRSP. So to get $107,000 after tax, you got to take out $200,000. That decimates $1 million RRSP pretty quickly. So I want you to have money outside your RRSP. TFSAs are great, and as those limits increase each year, that's going to be where a lot of these are. I say to everybody, a minimum of $200,000. What's the $200,000? It's 4 cars. It's a funny thing, but it's just the way that I look at stuff. Because in retirement, you'll probably buy 4 cars. The rest of your investment portfolio should be in Canadian dividend-bearing stocks and those generating capital gains, not U.S. securities directly held because of this U.S. estate tax problem. You use this to buy the cars, to put the roof on the house when you need the money for all those events that happen to everybody from time to time. Then you go to the beach. Or you go to the beach using some of that $200,000 you can afford to go there. Where is this? Georgetown. You should recognize that. So a professional corporation, a tax-effective place to hold your life insurance policies. Dentists shouldn't hold permanent life insurance policies in their corporation. One of the problems with the policies is once you put a policy in a corporation, you can't take it out because it goes in and it builds value as you're going along, especially if you have something like a term to 100 policy or a permanent policy. You can't take it out of the corporation. You can transfer it in, and when you transfer it in, you pay tax on some of it normally. But when you take it out, you pay a lot of tax because your corporation has to declare a sale of it, pay tax on it, and do all kinds of things, so it's ugly. So for DPCs, where they end up normally selling the practice and selling the corporation as part of the practice, you just don't want them in there. Invest in Canadian dividend-bearing stocks, U.S. direct investments. Corporations don't die, so you can buy all the Apple shares and everything else that you want in your corporation, not personally, because they don't die. You don't have to worry about the U.S. tax man. With Canadian dividends, the eligible dividends keep tax rates low for dividends paid. And there's no tax on dividends as long as you pay out a dividend from your corporation. So if you earn $20,000 in dividend income and pay out $20,000, you literally pay no tax in the corporation. So it's as good as an RRSP on those. Better, in fact. Tax rates on retained income, assuming proper dividends are paid out, are only about 20% in your corporation. So the tax rates are pretty good. If you don't pay out dividends, the tax rate's 44.5% until you pay out a dividend, and then you get money back from it. Then you get to buy a little place on the beach. So many people have seen this picture before that have been to my presentations. This is our house in Mexico that my wife bought without me seeing. And my sister told her, which is why we're in Mexico, my sister said, it'll only cost $5,000 to fix it up. She was kind of wrong on that. So this didn't work out quite as the $5,000 that we thought. But this is the end result. And you can see we're pretty close to the ocean, so it's not too bad. And that's kind of the end result. It's ugly, but then it's Mexico, so nobody cares. Total cost in on this is about $75,000. It's on the beach in Mexico, and it's pretty nice. Real estate. Real estate is a whole nother seminar that I do called Cottage and Recreational Property Presentation. It's 2 hours. It's on video. I think there's a link on our website to it. It's a good idea for diversification of your assets, rental property or recreational property. Remember, I tell everybody that says, like, how many people here want to buy their kid a house when they go to university? How many people want to do that? You must have heard my last speech. Okay. Okay. There's a lot of you that do. The deal on real estate is you got to hold it for 10 years. If you don't hold it for 10 years, the likelihood is you're not going to make any money on it. Occasionally you get lucky, but it's a bad bet in most university towns. It really is. So, and your kid won't be there 8 years from now. Some people have 3 or 4 kids and they all live in the house and they keep it 10 years. Fair game. I'm okay with that. But otherwise, it normally really doesn't work out very well. And it's another property to look after. My wife looks after a lot of our rental properties right now, and she knows it's a pain in the butt. So it's not fun. So buy before you retire to be in the market. So if you're going to buy that cottage, don't wait till you retire to buy that cottage or buy that place in the US, because what happens is when you retire, all of a sudden you're going, Mike told me I only get $9,000 a month. Anything you buy, it just doesn't have as much fun as when you're working in practice and making lots of money and able to pay for stuff and not worry about it. So it's much, much better to buy it before you retire. Watch out for high upkeep costs in retirement. Consider renting out for part of the year to offset the cost. So we're bad. We're very bad. We have a place in Key Largo. We have this place in Mexico. We have a cottage. All 3 of them are rented out all the time. So we're bizarre. And Jane puts up with it. I don't know why, but she brings in about $50,000 a year in rent, which pays for all those places. So we don't mind because we know that we rent it out. If I had to maintain those places myself and pay for that all the time, my charge out rate would have to increase a heck of a lot more than it does right now. Basically, they all pay for themselves, and that's because you buy at the right price as you're going in. And we watch out for high costs. Florida. For people that are looking for Florida or thinking about it, the rents are going up. Right now, to rent a place in Florida is $3,500 a month in the wintertime for your 3 months. If you're renting weekly, it's $1,200 a week. These rates are increasing quickly right now. Property is still a good value in the US, although it is recovering. The deals will be gone in 5 years. So if you're thinking about buying in the US, it doesn't have to be this year necessarily, but every year those prices are increasing. We bought our place 2009. Everything was on sale. It was crazy. It just didn't make any sense. So it was easy. Many Florida rentals are still a good value to purchase and rent to offset costs. That actually does work. US property does have tax issues, estate tax issues, current personal tax. You have to file a personal tax return if you rent it out. It's a bit of a pain, but if you bring in enough money, it doesn't matter. And it's deductible, so it's not a problem. Don't buy ski properties. You soldiers, right? Okay. Don't buy, like, nobody gets it. The demographics suck. They just don't work. And everybody comes, oh, I'm going to buy a place in Whistler. I said, Whistler property values are down 70% in the last 5 years. Duh, why? No snow. Nobody can afford to buy them, including the Japanese or the Chinese or anybody. So don't get caught on that one. Renting ski properties is a great way to go. So this is where I get into the interesting part of my cottage and recreational property show. This is a place in the Keys, $900,000, double lot, infinity pool, 100-foot dock, $900,000. This is a 2-bedroom cottage in Grand Bend. The other place is like 6 bedrooms or something like that. No pool, older place, looks nice, same price. So the values are there in the US still when you compare. I always ask people, I say, which of those properties do you think will appreciate more? This one or that one?
Appreciate or depreciate?
Appreciate more. Appreciate, not depreciate. If you buy it right. That's always the deal, right? So this is your final liquid asset in most cases, and is what will pay in part for your retirement home costs. So a lot of people get concerned and they say, well, what's going to happen to me? I've only got $9,000 a month. The retirement home's $5,000 a month. What am I going to do? And I'm saying, well, that's true, but more than likely you're going to sell your house. So if you have a recreational property, it's the same thing. If you're in the US, the medical costs will drive you out of the US. So that's going to be the first property that we'll sell in many cases. Then you'll be, then you'll have your home. So you have some capital from that to help you back at home. If it's a cottage, most of the time people will look and they'll say, I don't want to maintain 2 properties when I'm 82 years old. If my kids want to buy it, they can. But otherwise, it just doesn't make any sense. So that's where they use that home line plan that I talked about to sort of keep them while they're young and while they want to keep it. And eventually, though, good health care becomes the problem. Like the health care in Bayfield, where our cottage is, not really super good. Well, unless Peter's in town that day, and then I'm okay. So this is for cottages and for principal residences. If you have 2 properties, a cottage and a principal residence, keep everything. All your repairs, all your maintenance, everything. Because the best strategy for dealing with cottages that we use is the principal residence exemption, which means when you sell your house in town, we may not claim it as your principal residence. We may claim your cottage instead and actually pay tax on your house in town, but at a far lower rate than that cottage may have appreciated, because cottages tend to have increased a lot more than anything else. Every time you sell a principal residence, that's when you take that into consideration. Many people forget. I come in, I say, you have $1 million cottage that you bought for $195,000. You sold your house in town for $400,000 that cost you $300,000. You have an $800,000 capital gain over here. I could have gotten rid of that by claiming it on that house that got sold. So that's really important to look at. It's often overlooked by us advisors because sale of houses is not a taxable event in most cases. Have a strategy and a tax plan for the cottage or other property. Do the kids want to keep the cottage, and are they willing to pay for it? All the kids want to keep it. When you're writing the checks, they love it and they want to keep it. They want to keep the boats, they want to keep all our stuff. They love it. It works great for them. They say they do, but if it limits their lifestyle, they'll rather pay down on their own debt with their inheritance or use it to buy their own property or do whatever. Do they want to share it, or does one want it and can't? It creates a huge problem. So it's always a bit of an issue in there. Often it just doesn't work because there's not enough money and the kids don't know what they want. They really don't know what they want in the end. They still think they want stuff. So this is the end game plan. This is the new higher tax rates on income upon the last spouse to die means the higher tax costs on death. Uh-oh. Tax rates on RRSP and RIF can now be as high as 49.5%. Using a tax strategy called the pipeline can reduce income tax on your PC shares upon death from 34.92% down to 23%. Remember, your RRSP is taxed at that high tax rate. So I'm just going to jump to this slide. The important part is the bottom line that none of you can see down at the bottom. If you leave your money in your corporation, keep it in the corporation, deplete your RRSP, get rid of your RRSP. Your RRSP, you have probate fees at 1.5%. The income tax on $1 million, you're over $500,000, so you're paying tax at 49.5% on that. Even on $500,000, your net after tax on that $500,000 is $256,000. If it's inside your corporation, you save $125,000 by having $500,000 in your corporation instead of in your RRSP. This is the new plan. You know, keep that corporation for a long time. With life insurance, you have to keep it anyway because you can't get rid of it. So you have a permanent life insurance policy. You have to keep your corporation alive because you can't pull them out of the corporation. So that's basically how that works. And these are your advisors all trying to figure all this stuff out all the time. We're looking at each other, right, Sam? We're going, what the hell are we going to do? So consider changing your corporation's share structure. Once you're retired, you can change your share structure. You can bring grandkids in as discretionary shareholders. You can do all sorts of things. You can freeze the value of the common shares, take out future dividends and things like that. So remember how you put your kids on the dividend plan for those with professional corporations? Remember that, and you're paying them $50,000, $60,000 a year. You're paying $1,400 in tax. You're going, yippee. Well, I'm trying to do this down to the next generation, to the grandkids. So I'm hoping that that $500,000 that's in your corporation upon death will be able to be used to help fund your grandkids' education eventually. Yes?
Can you bring the minor
No.
grandchildren into that?
You can bring your minor grandchildren into it, but you have to be careful. It's a little complicated.
How do you do that?
It's a little complicated. It's not impossible, it's just you have to be careful what assets you put in there. The other thing that I do with a lot of people is I say put all your money into your corporation. So even if you have outside of RRSP investments, I suggest that people put everything in one bucket because it's easier to manage. And upon death, you don't pay probate fees on shareholder loans. So your corporation is really a good long-term benefit for a lot of people. When you also, in this case, we're saying transfer common shares to your kids and your grandkids, you keep the discretionary shares. So you become like your children, where you're kind of saying, yeah, but I need money. You still control the company, so you can say, I'm going to take out whatever I want out of my corporation. But your kids, upon death, may inherit some of the value that's left in there and skip that tax liability. It's complicated, but more and more of you are putting lots and lots of money in those corporations, so it's well worthwhile taking a look at. And then you can be happy camper and go swim with the dolphins. So by drawing down on your preferred shares over time, it works. The income earned in the corporation can be paid out to your grandkids to fund education, effectively transfers the value of your company to your children from you to defer tax with whatever's left over. The goal is to leave a lasting legacy for your family, for some. For others, it's like spend every dollar so that it works. You know, you also have the option of transferring any non-RSP, which I said. The strategy should be modified if there are any minor children. So. Let your family have it. I couldn't get the little babies because they're hiding at the back of that picture there. Okay, now let's talk about life insurance. I'm sorry, I'm running over time, aren't I? Yeah, I know. That's why I put it last, right? Because I knew she couldn't throw me out if I left that as the last one to put in. So this is a wave at our place in Mexico, and another reason that I continue to pay disability insurance, because I tend to do stupid things sometimes. So the life insurance problems, Low rates of return on universal life are causing policies to go upside down. I had a client the other day, he's 85 years old. The insurance company sent him a bill for $16,000 because his policy didn't have enough capital in it to pay his insurance premiums at that time. So I sat there and I said, well, how do you feel today? He said, I feel pretty good. I said, well, you know, you're 85, 86 years old. Like, if you feel pretty good, it's a guess. It's a $500,000 policy. Do the math, $16,000 a year, it probably makes sense for you to pay it. But you do the call on that. And that's a problem, especially with universal life policies. The best policies now are participating policies with a guaranteed component where the premiums are paid for by the policy. So my big deal with life insurance is I'm not one of these ones to build up a huge amount in a life insurance policy and pay it in, pay it in, pay it in. I just want to have enough money there that when you retire, that your premiums are paid for life. And some of these policies aren't working. So Terry and I have talked about this, and we really just find that these participating policies work. Some older guaranteed policies work, but new guaranteed policies where they guarantee this, that you won't have to pay that premium, they get really expensive, so it doesn't make a lot of sense to do. Run your insurance plans by an expert. I already gave you your trusted agent pitch. And what happens to life insurance when received by the corporation? A lot of people wonder about this because they say, well, but I'm the wife and I don't get any life insurance anymore. No, you don't. But what happens, sorry, you do. What happens is the life insurance goes into the company. On the death of the physician or dentist, the corporation receives the life insurance proceeds tax-free. Life insurance proceeds are added to the corporation capital dividend account, and you're able to pay that tax-free capital dividend out to whoever you want. So what I've done many times is I may have used it to redeem the preferred shares that are owned by the physician upon death in the structure, and then that way at least those go out without any tax on it. So it gives you lots of things. So it's still good to have it inside the corporation, still makes sense. On life insurance premiums, you save about 28% by having it paid through your corporation. So over time, that gets to be a lot of money. What happens to life insurance when received? Again, it just flows through. Your spouse becomes the new main director as the director of the corporation, so there's no problems with that at all. Use the proceeds to redeem preferred shares, and maybe you'll end up here. This is Portofino, by the way, for anybody that's a beautiful little spot in south of Italy. Oh, there's that Mexican Mike again. Okay, so I'm sorry I'm over time. I'm not bad.
Not bad. You're doing okay.
About 1 or 2 minutes. Did I talk too fast for everybody or too slow? Questions? If I've done a perfect job, I've answered them all. Yes?
So what you're saying, if I hear you, you take out money from your RSP first.
Yep.
If you have extra money, you can put in your corporation.
You can lend it to your corporation, and then all that it does, the reason that I like to have it in a corporation is as you get older, like you don't want to handle like this investment account and that investment account and that investment account. When you lend it to your corporation corporation can pay you interest, but also it's controlling your income. So instead of having, oops, I made a capital gain this year, which throws me over my clawback and everything else, if it's all inside the corporation, you get to control your income 100%. So it works really well. And for older people as well, what I find is it's always good to have an accountant looking at the books and reconciling everything every year. Because sometimes some advisors I get a little iffy on, and advisors are advisors. And I never choose them. Like it's always chosen by the people. Yes, Charlie?
When's the time to put that, lend that into the corporation? When's the right time to do that?
Normally after you've retired and as you get older. Like it's a ploy that I use when somebody comes in and they say, like, I'm 80 now and I'm having trouble keeping track of everything. Or if you're close to that clawback, and if I see a couple times we have a capital gain that throws you over, I might say, well, how much is your portfolio worth? Oh, it's a good day. You can transfer it tax-free into your corporation, so you don't have to pay any tax on selling it in. You take back some shares for the gain and a note payable for the cost base. So it actually works out pretty good, and there's actually a little bit of a very, very small benefit of earning investment income inside a corporation sometimes. Yes, Pete?
Do you own real estate personally or in a corporation?
The income properties, I think that if you're buying one, like your case is a little different, but if you're buying a new one right now, and if you look at the pillars that I'm talking about, it's okay to have real estate inside your corporation, but not the cottage, not your house, not any property that you think you will ever use personally. So our condo in Key Largo, we could have put it under our corporation, but I said, I use it personally, I don't want that problem. So for most of them, as I say, if it's a true rental property, it's okay to put it in. If you're buying an apartment for your parents, for example, and a condo, and it's going to be treated as a rental property and things like that, that's okay inside of a corporation because you've got lots of capital inside the corporation where it's tax-paid money at only 15.5% instead of 46%. So I'm definitely okay with it. Now, Brandon and I have this ongoing argument all the time as to how much is too many. And in some cases is some portfolios, if you have 5 or 6 of them, we're starting to think that might be getting past the stage of being treated as an investment and become more active. But for 2 or 3, I'm okay with 2 or 3.
Mike, I'm getting a lot of questions about what happens. Let's say you do an asset sale on your DPC, on your dental practice.
Yep.
Okay, so now you're left with your DPC and it's full of investments, which is the same as an MPC, a Medicine Professional Corp. So both of them are now full of assets, nothing else can be sold, and now the person is going to retire. What happens with that DPC and MPC? What does it become?
Yep. What happens is it just becomes a holding company. So what we do with people is we just convert it. So we stop re-registering and registering it as an MPC. You have to pay, it's about $250 to change the name. And I just basically change the name to Your Last Name Holdings, Inc. instead. And it just converts to a holding company. Now, once it's converted to a holding company, your children and your parents are no longer the only ones that can be shareholders. So grandkids can be shareholders, and different people can be shareholders. So it gives you more flexibility at that time. You have to do some freezes and things like that to keep the value in the right place, but basically it's good. And it's not a big deal. It's like happens like that. Yes?
Keep an MPC, Medical Professional Corporation. How much do you have to earn in a year to qualify? I mean, most of us, when you retire,
Okay, so let's say that you're continuing in practice after you retire and earning a little bit of money from that. The cost of the CPSO, Brandon, $350 a year? Oh, $125. Cheap. So you can keep your license. You have to keep up all of your licensing as well. And I suggest to people they continue using the Medicine Professional Corporation or the DPC, even if you're doing locums and things like that. Why? Because I can control your income then. So it all goes in, and I can say, well, I still want to hit that magic $110,000 a year and not get clawed back. So we can do that if you earn your income through your professional corporation. And you can still write off the earth, moon, and the stars, which is the biggest reason to keep working after retirement. Car expenses, everything else.
I just want to go on it because I get so many questions of this. So now we've got an MPC, DPC, you're no longer working, and now we've created Jones Holdings, Inc.
Yep.
Okay, so now we've got that, and now we can add all these extra shareholders, right?
Yep.
So we can add the grandchildren, let's say. And if our grandchildren are 1 year old, can we pay income from the corporation dividends to our 1-year-old?
No, because they closed that loophole about 15 years ago with something called kiddie tax, where it taxes it at the super high rate, 52% or something like that.
Well, you can't. You just pay that.
Yeah, you pay 52%. And you know how I hate to pay those high rate taxes, nothing over 46.41%.
So they have to be 18 to get
They have to be 18 to be able to get it. But you can do a freeze, which freezes your common shares. And then as you draw down your dividends, you take a redemption of shares. And then new common shares can be issued to children or grandchildren or a family trust. You can then have a family trust as well if you want. So all the rules about who the shareholders are go away as soon as you convert to a holding company.
You can add them any time along the way.
Well, you want to do your reorganization only once because you have to do a freeze.
Some of the grandkids are under 18.
You can add them at any time.
To be 18.
No, you don't have to. You can add them at any time. When they're 1 year old, you can have a child be a shareholder, but you hold the share in trust for that child. No. Gazillion dollars.
So you don't run afoul with the CPSO or?
No, as long as it's not another, like you can't own a variety store. This is kind of the one that I use all the time. Like you can't own an operating business through that. But your corporation, and this is something that I've used a lot of times, let's say that your child starts a company and needs help, buys a farm, whatever, okay? Corp to corp, you can lend money. So your corporation can't lend money to your son because it's your son, and he'll pay tax on it, or you will. But it can lend money to your son's corporation. So if you have kids that are getting started in their own business or doing anything like that, you can do that. You can have a holding company of your own, which we've done as well, to operate another business or to do something totally separate, and your corporation can lend money to it as well. So corp to corp is okay all the time, as long as your MPC, DPC isn't carrying on an active business of anything but the practice of medicine or dentistry.
Holding companies that give you dividends and shares isn't considered active business per se.
That's right, exactly. Exactly. So even your professional corporation could own shares of another private corporation. I haven't done that yet, but I don't see why it couldn't. Certainly public corporations and things like that are fine.
If you take a loan from the corporation, how long can you keep it without paying it back?
In my world, it should be gone after the end. Like technically you can go 2 years with it, but it's not a good idea. It attracts attention from CRA. So in other words, you can take a loan out, if your year ends December 31st, you can have a loan December 31st of say $50,000. December 31st, 2014, if you still have that loan of $50,000, Revenue Canada can add it to your income as a shareholder benefit. So it's not a good idea to have. And once those pop up, they always end up, oh, I'll pay it back, don't worry. They don't, and you end up taking out a big dividend to get rid of it. So loans don't work to you or your kids or anybody else. Sometimes we'll use them and clear it January 1st. So that's why we don't have a lot of December 31st year ends, because we don't want to be doing these on December 31st.
Do you pay any interest on that?
Doesn't matter. You or your kids, even if you held a regular loan at arm's length in your corporation, they'd still deem it to be taxable. Yes, Jeff?
Yeah, I just want to reconcile two pieces of advice you gave.
Oh, now, come on now. Remember, everything's changed.
Yeah. No, it's today, not today and 2 years ago, today and today. And I think the answer may have to do with your own personal circumstances, but I mean, traditionally the advice is, you know, if there are tax efficient ways of taking money out of a corporation, go for it. So if you can pay dividends to your children, if you can have your corporation buy life insurance policy that you hold personally.
Yep.
These are all ways of very efficiently sort of taking money out of your corporation.
That's right.
And if you need that money, that's a great thing to do.
Well, the other thing that I do, and I didn't really stress it here, was you build up that magical $200,000 outside when your kids are going to university. Because normally, if you got 2 kids in university, you can pay them $100,000 a year. Hopefully, it doesn't cost them $100,000 a year. So you're able to take back, you know, $50,000. That $50,000 can go towards your living expenses, or what I suggest to most people is I say, start building up that $200,000 now while your kids are in university, so that by the time that they're done, that you've got it. So that's why I always say to everybody, if you can pay a kid a dividend and get it out at a reasonably low tax rate, pay it.
Yeah. So the part about the reconciliation is, though, so let's say you're doing really well, and in terms of your 4 pillars, like which pillar did you call it? Your pillar 2, that you have a lot of personal investments outside of your corporation or
Yep.
RRSP. Now, you also said, oh my gosh, you want to avoid probate and all these other things. So try moving some of your category 2 money back into your corporation.
That's right. That's right.
So you're putting it back in.
Yeah, but you're just lending it back, which means you can take it out whenever you want it. So let's say that you've got $200,000 that's outside, and you want to be comfortable with it. You lend the $200,000 to your corporation, and the corporation, you know, whenever you need the money, you say, oh, well, I need that car. Well, okay, the corporation can give you the $50,000 because there's no tax on that shareholder loan. It's a shareholder loan. Yeah, it's a shareholder loan. So I always tell everybody, take out as much as you can at the lowest tax rates that you can. if you get those life insurance policies that you and I were looking at, where it's kind of like, is it worth it to pay the extra tax on getting this extra amount of money? There are times when sometimes it's just not, or it's like, who cares? And that's a different kind of case. But
Yeah, so you're sort of, as a shareholder alone then, and then if you, when you die, the money is then moved on to the next generation.
well, it's not, well, yes, it does move on to the next generation, because what happens is shareholder loans and shares, under the current probate act, it's being questioned a little bit, so this may change. But right now, you do a corporate will, so all of your corporation shares and any money you've lent to your corporation is not included in probate. So if you have $500,000 outside of probate, that's $7,500 you pay in probate if you die with that money outside, because the banks will make you get it probated. If it's inside your corporation and owed to you, you don't pay that probate fee. So I don't normally worry about it when people are younger. It's like something that as they get older and closer to that time. Yes?
Mike, you suggested when I first met you that paying off any charity should go from a personal income rather than from a professional
Yep.
corporation.
Yep.
Does that change when you turn 65 or?
Haven't really thought of it too much. Probably won't change at that time, I don't think. Charities are just, the only reason I like to do them on a personal basis is because you get this 46.41% tax credit. In the corporation, you get a 15% deduction. But the corporation's paying it. I've never really done the math to see which is more beneficial in the end. I've always just said do it personally. I'll look into that. Brandon, look into that, will you? Yes.
Life insurance in the corporation, does it apply only to individual policies? Can you have whole joint policies in the?
You and your wife can have a policy, that's fine. I've not done kids, and I don't think it's really appropriate, but you and your wife can.
In the PC?
Yep. Yep. We've looked into that, and there just doesn't seem to be anything against it. Part of it's a life insurance issue more than anything. Yes, I'll shut up, Brandon, if you want.
Oh, I have the answer to the donation. So what it was under the old tax rates, 2013 and earlier, it was about the same. So if you wanted to make a $10,000 donation, you needed to take a $10,000 dividend out of your corporation. The amount of tax that you would save in one or the other on a pure after-tax in your pocket basis, about the same. With the change in the dividend tax rates where it's going up a little bit, there is a slight advantage to having the corporation pay the donations, but it's not a ton. If your corporation's earning above $500,000, so if you exceed the small business tax limit, the corporation's the way to go for donations because you'll get a bigger bang for the buck by putting it through the corporation instead.
See, that's hot off the press, so it does make sense for us to do it through corporation now.
Then you still have a corporation rather than a holding company.
Same.
Yeah, same.
The only
As long as you got income in
The only
there.
danger with having corporate donations is charities love to give you a slip in your personal name.
Yeah.
So you always have to be cognizant of, did I pay this personally, did I pay this in a corporation, and not intermingle them. So you don't double dip by having the deduction on your corporate and then claiming the donation slip on
Yeah.
first.
The other reason to sort of do this within the corporation that I didn't mention, it's in here but it's buried, is if your corporation earns capital gains, only half of the capital gains are taxable. In your RRSP, a capital gain ends up being 100% taxable because it comes out as straight income. So right off the bat, you got a benefit out of earning it through a corporation. Also, from those capital gains, we're able to pay out what's called a tax-free capital dividend. So if you have a capital gain of $50,000 in your corporation pays tax on it, but we're able to pay you out a tax-free dividend of $25,000. So that's good because, remember, I put you on this budget, right? You only got $9,000 a month and everybody wants more money. That's how we get people more money. And we're just starting to see that with some people now where there are gains in the corporation and we're actually looking at, at paying out a capital dividend. So it's a great ploy to invest everything because when you're not in a corporation as an individual, it kicks you up above that old age security limit. And it's an accident almost, because every year we have to call people and say, make sure you don't generate any gains or anything. And sometimes brokers may not have stuff to sell that are losses to offset it. So it really is a good plan. It's a game changer, I think, in my language, I think. But Sam, you can't use it, okay? And Doug, you can't use it. Remember, I said it's copyrighted. Any other questions? Yes?
You have equities of U.S. companies outside of an RSP. Are you saying then you should transfer them into your corporation?
Absolutely.
Is it done as a loan, or you can just do it?
It'd go in as a loan, but you can roll them in as well.
And there's no tax on it?
Shouldn't be any tax on them, no.
So you transfer 100 shares of what?
Apple, yep, Apple, like with that big gain that some people have sitting on Apple, yeah.
And then,
I think, or is it taxable Canadian property? Maybe you can't. I'd have to look up.
and then the tax,
Yeah, I'm not sure that you can.
once it's in the corporation, you say the tax rate on it, capital gains a lot less.
No, the tax rate's the same in the end after you pay out the capital dividend and a regular dividend. There's no tax savings, but it's a management thing, right? Where you're saying, I don't want any surprises this year. And that's really where it works well, because in your corporation, it doesn't care. You can have $1 million of capital gains in your corporation. The tax rate's exactly the same. It's still high, but it's still exactly the same.
We have time, is there any more questions? Yeah.
So just one thing I didn't quite understand. You said that when you have a child in university, that's the time to save your $200,000. I'm not sure exactly what you mean by that.
Well, what happens is that depending on what university they're going to, you can normally pay out a dividend of about $50,000 to $60,000 a year. Generally, it doesn't cost them $60,000. So they, out of the generosity of their heart, gift back to you $30,000, the money that they don't need or spend, just like you gifted them money over the years for everything else. And then you take that $30,000 and can invest it. In fact, it's better if they gift it back to the spouse with a lower income as well, so that you can get some income splitting. That's another thing that we do for people.
I think what we'll do is we'll close out the
Yes.
questions. It's a very good topic, and we've had great questions. And Mike is going to be around, Brandon, Sam's around, Jerry's around. There's a lot of great people that are around, Mary Jane's around, and that can help with answering some of these questions, because this topic is really, really hot. And Mike did a wonderful job in giving the answers to our most asked questions in a simplistic, easy to understand form. And I think all of us will walk out of here, Mike, understanding a lot more about retirement and MPCs and DPCs. So thank you for that presentation. It was truly
Thank you.
appreciated.
Thanks.
I want to say that Mike being the charitable guy, that there is a charitable donation that's being made on his behalf, and thanks for coming here today. I actually have just a couple of summaries of what you said, Mike, and actually I'm being very serious when I say that the one little thing I've noticed, that if you don't like your spouse, would you try to separate them way before retirement? Because if you do it the year before you're going to retire, you're never retiring. I've noticed that. Have you noticed that?
Mm-hmm.
It's
I've
not
noticed a
good-
couple times recently where I
Yeah.
just said, they're not here, are they?
Yeah.
No. Good.
I always say I'm going to write the book on financial planning. It's like, watch the number of spouses you have, watch your kids, and don't get into horses. I mean, I think it's pretty simple.
It's a perfect retirement
Yeah,
plan.
it's a perfect retirement plan, and so that's the way I've gone. But I'm now going to add, like, if you've been pretty good all the way along, the time not to leave your spouse is the year before you're going to retire, right?
Well, that's not exactly true.
Oh,
I can
it is?
explain to you, there's another little shift on that,
Oh, there
which is it
is.
probably is better to do it at retirement instead of 2 years before.
Oh, what are we going to do then?
Well, the reason, do you really want the reason? No, the reason is because if you go at age 63 and if
Yeah.
you say, I was always going to retire next year, but I wasn't, the courts will look at your income and you'll pay support of some 40% of what your income is while you're working.
Okay.
So once you retire, there's no 40% of your bigger income. It's
There you
40% of a much
go.
lesser income.
See, I
So
never thought
there's
about
a
that.
there's a little twist on everything in my life. Sorry.
Well, this leads me to my second point. It doesn't matter what you're doing. You're going to work, you're going to retire, you're going to separate, you're going to give a charitable donation, is to speak to your advisors. I cannot begin to tell you how important that is. If you've got a plan in your head, probably 50% of it will work, and you need to have a good advisor that is going to help you through that process to make sure that the thing is tax effective and actually makes a whole lot of sense. And I always remember, if you want to really understand medicine, and diagnose yourself, you should go to the internet, because that tells us all. And that's exactly what I hear when I talk to people, and I know a lot about accounting, but as soon as, you know, it starts getting technical and I know it's wrong, and I can kind of tell you why it's wrong, and I'm thankful that you've even said something to me so I can say, oh, please go and speak to somebody, because that is not going to work. That's the reason why we have accountants, and I can't stress enough about the importance of having the proper accounting advice and moving forward. These MPCs, DPCs, when they move over to holding companies, it's really a glorious thing. You will be so free on all sorts of rules when you can have Jones Holding Inc., and you can add all sorts of shareholders, and you can do all these wonderful things. It's a good thing, but somebody has to plan it out for you. And that's what Mike does. And of course, we've got Brandon in the background that is obviously got lots of ideas as well. The other big thing that Mike talked a lot about is retirement income planning. And that's going to be huge. Right now, when we're earning income, we learn how to spend it. We wonder if it's going to be dividends or salary. Wait till you retire, right? It's going to be, do I take my RSPs? Do I take my dividends? Do I take my CPP? What do I do with OAS? My last point was don't discount life insurance. If you do have life insurance in your corp and the thing's going to work for you, it's not one of those crazy policies that Mike talked about. If they got a lot of cash value, you can reverse mortgage those things too. So you can reverse mortgage your cottage, reverse mortgage your house. If you're really sick, right, you need money, you can reverse mortgage the cash value in your life insurance. And then when you die, they sell the house, they get the money back, they sell the cottage, get the money back, and they sell, or so
wife?
you get the
No.
death benefit, no. You get the death benefit and it pays off the loan. So, I mean, there's lots of things that are going on. So thanks for making that so easy for us to understand, Mike. So a couple of things. I was supposed to tell you in the very beginning that this seminar is being recorded for people that could not be here. And so if an audience member has made a question or given a question, it's quite likely you're on the recording. And Mike at the back there wouldn't mind getting your okay to use so that you know. Sam's there too, Samantha. She wouldn't mind getting you to sign to say you knew you answered a question and you know that you're on the video recording. This is not going on YouTube all over the world. I mean, this is just so that we've got a recording. It may go on our website as well.
And on ours.
Yes. Also, too, there are sheets on the desk, on the table, with regards to feedback. They're so important to us because it helps us determine what topics are important to you. Please fill those things out. Just know that our next discussion, our next seminar, I think Push is giving it. Is Push here? Well, Doug's here. Doug's here, Plummer. It's all going to be whether to take salary or dividends. We're going to be talking about that out of the corporation. I also have an economist coming. Who's going to talk about the state of the world and what that economist thinks is best to start investing your money in and not investing your money in going further. And so if I get some ideas from you, I can bring in lots of speakers, and Doug can keep cooking. And thank you very much, Doug, for the dinner tonight.
Thanks, Doug.
Thank you all for coming, and again, Mike is here, Brandon's here, Jerry, all the accountants I've listed before, Sam, Mary Catherine, Jenna, Stephanie, Jerry, Michael, Doug, Duncan. So they're all here to help you out, and thank you again. Have a great night.
Thanks.
Thank you.
Thank you, Terry.